Welcome back to Financial Insights in Minutes.
Today, we have a packed episode featuring top experts breaking down the latest economic signals.
With inflation rates cooling, but consumer concerns rising, can we trust the market?
Join us as we uncover insights on how CPI inflation and Fed rate cuts interplay in shaping the economy.
Stay tuned for our analysis of several expert opinions, including Adam Taggart and Ted Oakley.
Let's dive into today's featured videos and find out what these experts are saying.
First, Eurodollar University dissects the alarming trends in consumer spending and macroeconomic pressures. Next up, David Lin hosts Peter Boockvar as they analyze the latest drop in inflation rates and discuss implications for the economy. In an informative session at EPB Research, we unravel 3 critical recession indicators that investors must pay attention to. Ted Oakley, from the Julia LaRoche Show, discusses the importance of maintaining liquidity during market sell-offs. Adam Taggart joins Kitco News, probing into whether we are experiencing a hidden recession amid rising inflation. Finally, Pease from Thoughtful Money analyzes the risks tied to overvalued U.S. stocks and outlines strategies for value investing. Trade Brigade warns about the dangerous market dynamics where over-optimism among longtime investors could lead to corrections. Lastly, Mott Capital connects stock market rebounds with fluctuations in the Japanese yen, examining the underlying economic data. Welcome back to Eurodollar University. Today we're diving into some economic turbulence, what's really going on at Home Depot, and why are consumers holding back.
That's right, Jeff Snyder, our guest today, holds a wealth of knowledge in macroeconomics and financial markets. With such insights, he unpacks the complexities behind consumer behavior and economic signals.
So what's the key thesis here? What's causing the current economic ripples?
The core thesis suggests that consumer worries about unemployment are now more significant than high interest rates. This shift has resulted in decreased spending and overall economic uncertainty.
Let's break down the key points. Starting with Home Depot, what's happening there?
Home Depot reported a troubling 3% decline in same-store sales this quarter, and transactions are down 2%, highlighting consumer restraint directly tied to economic concerns.
Next, how's consumer confidence faring?
There's been a shift to a deferral mindset. Consumers are holding off purchases due to rising economic uncertainty, especially regarding job security.
What about the gasoline market?
Top refiners are throttling back operations due to lower demand, raising alarms about a potential supply glut. This hasn't been the narrative we've been hearing.
And we can't forget the CPI report from July, right?
Exactly. The CPI indicated disinflationary pressures, with the core CPI showing its weakest changes since June 2020, a serious sign of economic trouble.
Looking ahead, what predictions can we draw from this analysis?
With these signals, it's likely we will see continued economic weakness, especially as worries about unemployment intensify, further dragging down consumer spending.
And regarding the energy market,
challenges lie ahead. Oil prices may not rebound quickly as refinery operations taper off due to low demand. Watch this space.
To wrap it all up, what are the main takeaways from Jeff's insights?
The landscape is shifting, and consumers are rethinking their spending habits based on rising uncertainty, particularly around job security. It's crucial for businesses to adapt to these changing dynamics.
What are your thoughts? Is the economic outlook looking grim, or is there hope on the horizon?
Drop your thoughts in the comments below. Let's engage on this critical topic.
Welcome to David Lin on YouTube. Today, we're diving deep into the recent drop in inflation rates and what it means for the future, especially regarding interest rates. And with us is Peter Boockvar, CIO of Bleckley Financial Group. Buckle up for some enlightening insights.
Absolutely. Peter has been dissecting economic trends for years, providing keen analysis on how shifts in inflation impact consumers and markets alike. Let's set sail into today's discussion.
So what's the main thesis of Peter Boockvar's analysis? What's the big picture here?
The core thesis revolves around the recent drop in inflation to 2.9%, the lowest since 2021, but Peter stresses that while it's a positive sign, we need to question if this deceleration is sustainable or just a temporary ease in a larger economic struggle.
Let's unpack the key points. First up, inflation trends. What's the latest?
Peter highlights that inflation has dropped to 2.9%. While this is encouraging, consumers are still grappling with high costs from the 20% increase over previous years. It's like being excited for a sale but still needing to fork over way too much cash.
And what about consumer behavior? How are people reacting?
Despite lower inflation, consumer confidence remains muted. High-income groups are more resilient, but the lower strata still feel the pinch. Spending isn't bouncing back yet, making the economic landscape really complex.
Now let's talk about market implications. What's Peter forecasting here?
Peter emphasizes that the stock market is now more reliant on actual economic and earnings growth rather than just potential Fed rate cuts. It's like needing to prove you can swim before jumping off the diving board.
What risks do we need to keep a lookout for?
Peter warns that continued economic deceleration could lead to a recession. Earnings growth expectations are not priced into the market yet, which could lead to significant corrections if the economy doesn't pick up.
And what predictions does Peter make about interest rates?
He anticipates that while inflation is easing, long-term interest rates will likely stay elevated due to ongoing economic stress and rising federal deficits. So, tightening the purse strings could become a common theme.
What about the role of technology in this equation?
As technology progresses, it creates tools that could lower costs over time. Peter suggests that while services inflation remains, goods may see price reductions, leading to a new dynamic in how we evaluate inflation.
So as we wrap this up, what are the key takeaways?
The drop in inflation is a welcome relief, but it's crucial to monitor its sustainability as it relates to consumer spending and broader economic growth. The future is murky, so keep your life jackets handy.
And what should viewers watch for in the coming weeks?
Stay alert for economic indicators that could impact markets and consumer behavior. And don't forget to comment below with your thoughts on inflation. Are we really out of the woods?
Welcome to EPB Research on YouTube. Today's topic dives into recession predictions, focusing on 3 key indicators that have a great track record. Let's set sail on this economic exploration.
Absolutely. The analysis here is critical, since most investors either misuse these indicators or ignore them entirely. Stick around as we unpack their current implications for a potential recession in 2024.
So what's the main thesis of the video? What's the bottom line here?
The core thesis is about 3 indicators that have historically predicted recessions. However, their correct interpretation is often overlooked, leading to misguided evaluations of economic health.
Let's break down the key points about the Duncan Leading Index. What can you tell us?
This index focuses on 3 cyclical components that truly drive the economy: durable goods consumption, residential investment, and business equipment. Excluding non-residential structures enhances its predictive power.
Interesting. What's the disconnect about consumer stability?
While consumer spending is thought to drive stability, true volatility is found in business equipment and residential investment, which react sharply to economic shifts.
What's happening currently with these indicators?
With the Fed's tightening, these indicators show a downward trend. Interestingly, auto equipment investment is behaving counterintuitively due to supply chain issues, complicating our understanding.
What predictions are being made about the economy heading into 2024?
The current metrics highlight a slowing economy. As supply chains normalize, these indicators could expose even more vulnerabilities.
To wrap things up, what's the big takeaway from the discussion?
It's crucial to focus on the cyclical sectors. They provide the best insights into economic changes. Viewers should pay close attention to these indicators to prepare for potential downturns.
What should professionals take away from this?
They need to accurately utilize these key indicators rather than overlook them to navigate through upcoming economic waters more effectively.
What's the call to action for our viewers?
Drop your comments below about how you interpret these indicators and what you think the economy will do next. Engagement helps boost our economic compass.
Welcome back to the Julia LaRoche Show on YouTube. Today, we are diving into the turbulent waters of market sell-offs with finance veteran Ted Oakley. With his extensive experience and insights, Ted will help us decipher recent market shifts.
Absolutely. Ted brings a wealth of knowledge, having spent over 40 years analyzing economic trends and advising clients. So buckle up as we navigate the currents of this unpredictable market together.
So what's the core message Ted gives us today?
The main thesis is clear. If you don't have liquidity, today's market sell-offs are not an opportunity for you. Ted believes many haven't grasped this reality, which could lead to missed chances.
Let's break down those key points. What highlights does Ted emphasize about our current economic landscape?
Ted points out that real wages have not increased significantly over the last 20 to 25 years. For instance, if you're buying a $400,000 house, you're looking at about $1,500 a month before including the actual mortgage payment.
Interesting. How does Ted view the Fed's impact on the economy?
He argues that the Fed is too closely tied to market performance, often reacting to stock market fluctuations rather than economic fundamentals. Rate cuts, he warns, are usually a response to worsening economic conditions.
This disparity is staggering. What does Ted suggest about Wall Street versus Main Street?
Ted highlights that while Wall Street executives are benefiting, the middle class is effectively being priced out of the American dream, showing a troubling disconnect between asset ownership and economic well-being.
As we steer into the future, what predictions does Ted offer?
He predicts that continued economic struggles for the middle class will ripple through the economy, leading to more bankruptcies and challenges for heavily leveraged businesses.
And what about the Fed's upcoming decisions?
Ted sees potential rate cuts leading to short-term market pops, but cautions investors that these cuts are not indicative of economic recovery, but rather a last-ditch effort to mask deeper issues.
Wrapping it up, what should viewers remember from this discussion?
Ted's overarching advice is clear. Maintain liquidity. Without it, you may miss out on valuable opportunities in downturns. As markets evolve, being cautious and prepared is paramount.
What do you think about Ted's analysis? Do you believe liquidity is vital now?
Share your thoughts in the comments section. How are you preparing for potential market shifts?
Welcome to Kitco News. Today we're diving into a pressing question. Is the U.S. facing a hidden recession?
Joining us is Adam Taggart, a financial expert with decades of experience and the founder of the Thoughtful Money podcast. Let's see what he thinks about the latest CPI numbers.
What's the key takeaway from Adam Taggart's insights on inflation?
Adam believes that while inflation appears to be cooling, many consumers feel they are in a recession due to stagnant incomes struggling against inflation.
Let's break down those key inflation points.
The CPI rose 2.9% in July, with core CPI at 3.2%. A staggering 90% of this increase came from rising housing costs.
What's happening with the Federal Reserve?
Adam predicts a likely rate cut in September, but not as steep as 50 basis points. The market remains skeptical about the Fed's promises.
How do consumers relate to this economic picture?
3 out of 5 consumers feel their incomes are lagging behind inflation. Many are worried about job security, adding to recession fears.
What are the predictions for the market?
Adam suggests we may see corrections in the market post-election regardless of the winner, as the need for natural adjustments arises.
Gold's performance seems promising. What's the outlook?
Gold is nearing all-time highs, with more investors and central banks showing interest. Adam anticipates significant upward momentum for gold.
Any predictions about market corrections?
Adam predicts corrections will likely happen post-election, shedding excess market pressure in favor of natural adjustments.
And what about consumers moving forward?
There's an expectation that consumer financial burdens will worsen as inflation outpaces income growth, increasing recession fears.
To wrap up, what's our takeaway from Adam Taggart's insights?
It's essential for viewers to stay informed and adopt strategic financial practices to navigate ongoing economic challenges. What are your thoughts on inflation? Let us know in the comments.
Welcome to Thoughtful Money. Today, we're sailing through the turbulent waters of the U.S. stock market with none other than John Pease from GMO.
That's right, John is an expert on market dynamics and the deep value investing approach. He brings a wealth of experience analyzing these market fluctuations.
So what's the crux of John Pease's argument?
The key takeaway is that most U.S. stocks are overvalued, which means their returns may not justify the associated risks. John stresses focusing on pockets of the market that provide higher compensation for equity risk.
Let's break down John's main points. What's happening with current market valuations?
John indicates that the U.S. equity market is overpriced, and this is likely to lead to disappointing returns moving forward. In contrast, deep value stocks remain significantly undervalued and present an attractive opportunity.
And what's the strategy around quality investing?
Investing in quality companies which have stable profitability and solid balance sheets can offer investors a safer haven. According to John, these companies experience less downside during market volatility.
What about the economic outlook?
John predicts signs of a slowdown in economic activity, making it essential for investors to tread carefully as recession risks loom.
Next, what are John's predictions?
He forecasts that the Federal Reserve will maintain relatively high interest rates, which could keep pressure on equity valuations.
Any insights on market performance?
John highlights the potential for international markets, especially emerging markets, to outperform the U.S. stock market moving forward.
To wrap things up, what should our audience take away?
Investors are encouraged to focus on deep value opportunities, quality stocks, and consider international markets as the U.S. equity landscape may present unappealing risks.
Any final thoughts for our viewers?
Engaging with one's investment strategy is crucial. It's important for viewers to reflect on their portfolio approaches in light of these insights.
How can the audience stay ahead?
Following expert analyses such as John's can help investors avoid pitfalls in an unpredictable market. Don't forget to comment your thoughts below.
Welcome to Trade Brigade on YouTube. Today, we're diving into the turbulent waters of the current market conditions. Why is it considered dangerous right now? Buckle up.
Absolutely. With confidence surging among longs and stubborn shorts clashing head-on, the market presents unique challenges. Today's analysis will guide viewers through this stormy sea.
What's the core thesis of today's market update?
The crux of the matter is the tension between over-optimistic longs and stubborn shorts. The market tone is shifting, making it tricky to predict the next moves.
Let's break down the key points. What's going on with these market dynamics?
Long investors are riding high, anticipating new all-time highs. Meanwhile, shorts are clinging to outdated beliefs about a downturn.
How are economic indicators impacting the market?
CPI data indicates stability in essential prices, but PPI reports some pushback, leaving traders on edge about their next moves.
What are the major levels traders should watch?
Traders must keep an eye on the 547 resistance and 532.50 support levels. Breaking these could signal a strong trend movement.
And what about market volume?
Recent strong inflows indicate purchasing pressure. However, declining volume could hint at a reversal. Stay alert.
What predictions are being made for the near future?
Expect possible pullbacks as short sellers gain visibility. Upcoming earnings could also either shake things up or provide a much-needed boost.
So what are the predictions we're looking at?
One of the primary predictions is a potential pullback. Excessive confidence among longs might result in a quick market correction.
What about the next wave of earnings?
Earnings reports are crucial. Positive results could restore confidence, while negative outcomes may spike volatility.
To wrap it up, what are the key takeaways?
Viewer engagement is essential. Keep an open mind and prepare for unpredictable outcomes. What do you think will happen next in the market?
Any final thoughts?
Traders should remain vigilant and adaptable. What strategies are you considering? Share your insights in the comments.
Welcome back to Mott Capital's Market Chronicles. Today, we're diving into the fascinating world of stock markets and how the stalling Japanese yen is influencing their rebounds.
Absolutely. We're here to dissect how recent economic data is steering market trends and what that means for investors.
So what's the crux of today's discussion?
The core thesis revolves around how the recent economic data signals that stock markets are rebounding, largely driven by the stalling Japanese yen, coupled with expectations that the Fed might cut rates soon.
Let's break down some essential points, starting with the CPI insights.
Right, the CPI report came in as expected with a yearly rate of 2.9% and core CPI at 0.2%. These numbers reflect how effective CPI swaps have become at predicting trends.
And what's the anticipated impact of these potential rate cuts?
Well, with lower CPI and PPI, the Fed is more inclined to cut rates, which would tighten interest rate differentials, strengthening the yen further.
Interesting. How does the yen's behavior affect the stock market?
The yen's recent sideways trading has actually allowed stocks to rebound. Additionally, a drop in implied volatility is giving the market some breathing room.
Let's touch on currencies. What's the connection with oil prices?
Exactly. The Canadian dollar and Mexican peso's movements are heavily influenced by oil prices, which are starting to fluctuate. This relationship is crucial for market dynamics.
What predictions stem from this data?
We might see Fed rate cuts as early as September, which would keep interest rate differentials contracting and could further strengthen the yen.
And how will market trends unfold in the near future?
If the yen continues trading sideways, the stock market might enjoy further stability in the months to come, but any volatility could still shake things up.
To wrap things up, what's the main takeaway?
The stability of the Japanese yen and the Fed's actions, based on the latest economic data, are crucial for understanding future stock market behavior. Viewers, what are your thoughts? Drop a comment below.
In closing, we've seen how leading experts portray an unsettling picture of the current economic landscape.
Adam Taggart rings alarm bells regarding consumer sentiment amid inflation, while Ted Oakley underscores the essence of liquidity.
Together, they emphasize the intricacies of the market, where caution may be the best strategy moving forward.
So what are your thoughts on these insights? How are you preparing for potential market shifts?
Thanks for watching Financial Insights in Minutes for August 15th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.